Hi everyone, welcome back to my channel. Today we're going to talk about growth stocks, in particular HIMS stock, and how these are getting affected by the negative market that we're seeing here at the moment. Volatile market, fears of recession here, drying up capital in terms of venture capital and so forth. And we've seen basically last 6 months most tech stocks are down hugely. So we have Amazon down 40%, Tesla down 40%, Google down around 30%, and even Apple and Microsoft are down from their all-time highs. And we had a similar picture for HIMS stock, which after it basically IPO'd via spec, it went all the way up to $24 in a peak hype moment in February 21. And since then, slight recovery here May, but really just going one way, and that is down. And now we're back at $360 per share, which equals a market cap around $700 and something million, which obviously is down from their spec price, which was held at $10, which is always the case. And today I want to really put that a little bit into perspective by looking at another stock who had, over the past 20 years really massively outperformed the market, who had a specific business model that people wouldn't really believe in, had a huge growth story ahead of them. And we were just going to look at it, how it would have played out if you were in that moment. So we're going to basically travel back in time, pretend we invested into that stock the same way we're doing today into HIMS, and we're going to look at how strong of a stomach would have an investor back then had to have in order to hold on to the stock through all its peaks and troughs, and really look at it from that perspective to fast forward, look into our investment into HIMS stock in today's world to see, what might be coming, what might be ahead of the company, and the reason why we should even be holding on to this even after a significant drop. I mean, even if you invested into the last months when it was around $5, $6, you're still down almost 50% on your position basically. So we're going to look into that to see, how would it actually look like if you were to hold this on for a longer time, and the thesis plays out and the stock becomes a successful company and success story, which then translate obviously into the stock price. And the stock we're going to look into today is Amazon stock. So obviously everyone knows about Amazon. They're a huge retailer worldwide, the largest online retailer, and just a massive company. And they started really small with basically selling books and selling CDs and so forth. And they were one of the first online retailers to do so. And that's where, they basically had that opportunity to gain a lot of market share. And we want to look at, let's pretend we invested around the IPO time, which was around in 1997. We were going to pretend that we've invested into Amazon stock right here. And what would have happened if we just put in our money, let it ride, let the thesis play out, and not look at the stock price, not get, drawn away from any sort of macro trends, recession fears, or anything else. What would have happened to us, right? So let's look at the price here. So we IPO'd at around $1.90, so let's call it $2 a share. And then obviously, I had a little bit of a ride up quite consistently over almost $10 when everyone started to see some sort of potential. So let's say you've invested around here, and you kind of, after like half a year IPO, you read a lot about the company, and you basically said, okay, let's invest to it at $5 a share. That's pretty good, right? So you would have basically gone through a super hype cycle where the internet and retail and anything that had to do with internet was basically the next big thing. Everyone saw the trend. Everyone recognized this is going to be a huge thing. This is going to have a huge addressable market, and this is going to be the future of commerce, the future of how we deal with things, the future of how we order things, and so forth. So obviously Amazon being there at the forefront, consistently expanding their product offerings, and people would recognize that, and then it would become sort of a hype stock in that moment, right? So you would have seen here that, from all the way from $5, now we're looking at $40, $50. It goes all the way up. And then what happened in late 2000, basically you had a bunch of these types of companies, but even less profitable or not even making money as of yet, just having basically an idea for an online presence, for an online business model, getting it out there, bringing it to the market via IPO. The money was obviously there to support that. And then you had a bunch of companies flooding into the market called blah 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 dotcom, right? And that's what was called for the dotcom bubble, where you basically had all these hype names being the next big thing, and people were running into it, basically flooding into their money. And then when that all came crushing down, when people realized that, wait a second, I've just bumped up a price of a stock that doesn't have any revenue, that's not making any money, and that might take another 20 years to play out, if they even ever play out at all. And then Amazon was obviously one of the better ones of those. But nevertheless, everything that had to do with .com had been crashing down from there. So you basically invested $5 here, the stock went all the way up to over $100 a piece. So you made a huge return on your money. So the question is, would you have already held on to it or not, right? But in that moment, it's like, you're the smartest guy ever. You basically invested $5. Now it's $100. You look like the smartest investor on earth. And you're just going to be like, well, I'm just going to hold on to it because Amazon just started out and they have a huge future ahead of them, right? So your portfolio just basically 20x'd. And then you would see it the following months going down, going down, going down. Now we're sitting at $40. Now we're sitting at $30. And then after almost 1 year, like one total year since you've had that $100 price, you're looking at a price to share of $20. So you will say, okay, I'm still up 4x, but kind of like, did I make a mistake here or not? Like, you basically had the chance to sell out at 100, but you didn't do it because you believed in the company itself. And now the market, has drawn that stock into this type of category where it says, that's worth nothing. That's all been just hype. That's been just, overhyped. Takes years to play out, really. And, whatever has .com in it is nothing worth, and we need to get rid of it. So there's just been this loss of appetite, like the same way we're seeing today with the loss of risk taking for any sort of growth companies that don't make money yet. The same thing happened basically back then when everything came crashing down. So that almost, let's say, call it 3 years later, 3 years after your initial investment, you are pretty much at break even again here in 2001. So basically 2 years later, you would have seen your portfolio go 20x if it was made up only of Amazon stock, to only come down to exactly break even here 3 years later. And then the thinking about this is basically that whole hype period was obviously an exuberation of the potential of these .com companies in that moment, and too much hype, too much future potential was already priced into the stock, so that it wasn't a sustainable moment. So even though Amazon had a huge future ahead of them, even they were completely blown out of proportion in terms of where they were actually at that point of time. And then basically, it was just all, it had to come down to, get to the baseline again to actually reflect the fundamentals of the business, because that's what's always happening. You basically have a fundamental line when there's a growing business, which goes like this, and the stock price will go like this. It will be significantly above the fundamentals, and it will at times, which is arguably in 2001, it will be significantly below its fundamentals, just because the whole market is in this constant trend of, oh my god, this is the next thing, so everyone's piling into .com. Then everyone says, oh my god, .com are the shittiest companies, like no one's piling into it. So then everything just gets the same stamp. Either it's the super hype, yes, I make money with that, or it's, oh no, those are hype stocks, you don't make money with that, you can't invest in that anymore. So this is what we're going through at the moment as well. We had that hype period where there was a lot of money in the market, a lot of IPOs, venture capital was, abundant, a lot of companies were funded. Now we're going through the opposite. We're saying, okay, money is drying up, valuations are getting, discounted heavily, there's recession fears, there's interest rate hikes and so on. So that now we are in this moment where anything that has to do with growth, which 1 year ago was the thing to do, the thing to invest in, the thing to watch, because it would go 10% every week. Now that's the worst possible investment to make. So, but you as an investor, you have to ask yourself, what type of investor are you? Are you someone who's just following the trend? Well, then in that case, you would have to be, watching the market, watching the macroeconomics, watching the sort of the trends, and you would have recognized that, oh, wait a second. So if inflation goes up, interest rate goes up, probably what's going to happen with the supply chain issue, that energy like gas and oil prices have to go up. So I'm going to pile all my money from Google, Amazon, and all these growth stocks. I'm going to put it into the energy sector. So obviously afterwards it's always very easy to see, to say, oh yeah, you should have just pulled out that once the headlines came out, you should have just pulled that out, put it into energy, ride that wave, sell again, and put it over again to Google when it's cheap. I mean, obviously sounds like an ideal strategy, but it's not really something that you would call investing as such. It's not like, that's more something that the hedge fund managers doing on Wall Street, because obviously they're dealing with millions and billions of dollars. They're already managing a huge amount of wealth. So their mode is more like wealth preservation versus wealth creation. So for instance, if you have already 100 million to your name, why would you want to risk it into HIMS stock, which might not even play out, might not ever be profitable, when you can just get a nice 5 to 10% return on your money every year? Basically, that's the thinking. So they rather give up some potential gains for stability and less risk. So, but that's basically, everyone else has to determine their risk profile, their investor profile, their investment horizon. Everyone will be different. This is just this is for the types of people that probably want to create wealth, so they need to risk more in order to create that. So yeah, but back to the Amazon example, we'd basically sit here after 2 years, 3 years, nothing would have changed. But then what's funny is when you think about all these moments of, oh my God, you had all this money, then you lost, oh my God, you were so depressed here, you basically said, oh my God, I did everything wrong, I could have sold it, I was so high. But then if you just left the money here when you invested initially, and you just zoom out, you just don't do anything, and you just follow the company, how it's performing and performing and performing, and then in the end of the day, if you look at the actual stock price like this, where do you even see that period when you were so annoyed and so depressed about, oh my God, how much money did you lose? Like here, you can see where the volume is so high. This is when all that stuff happened. But if you zoom out like this, you can't even barely see. I mean, you see, yeah, that went a bit up here and then came down. But in that moment, it's so crazy for you that it went up all this way and then came down all that way. But from a long-term perspective, it doesn't make any sense. It doesn't really matter at all. You would just hold on to a great business, keep following up, keep following on the financials, having look, are they getting better? Are they growing revenue? Are they keeping margin? Are they increasing margin? Are they gaining market share? Are they having new acquisitions, new businesses? Are they expanding into new areas? That's what you want to see, and that's what Amazon had been presenting every time they issued their financials. So that's why over time the stock price is more looking like a line up, in line with the growth of the business. So when we look back at HIMS, we're just at a very early stage of a company that's very young and with a huge growth potential, similar huge market opportunity with the telehealth market. They also created a company that is very niche, similar to Amazon in the beginning, as they're more in the niche market of mental health, but also actually skin conditions and hair loss and sexual treatments and things like that. So they created that little niche market of the telehealth market, but still they are the player in that market. So they might as well, if they are established, they're very well positioned to add on more and more types of products, such as chronic diseases and so forth. So very well positioned, similar to Amazon, where they actually mastered one category first, like the books, then they added on CDs, then DVDs, and so on. So they kept adding categories on, and then overall now they basically pretty much got everything, plus a whole bunch of other businesses. So yeah, what I just want to show you is like, we're very early in the early stage of this company. If you look at this, we're basically like over here. So we're all the way here. And we could have been going all the way up. We're now pretty much, we're down here. So we're pretty much like, this part could be potentially pretty much be this part. And then after that, it keeps going up based on the fundamentals. You will always go back to the fundamentals eventually. Now, right now, we're in a very high fear market. We're just super high fear. The fear and greed index is extremely fear right now. We're just potentially heading into recession. So, the only consideration here is, obviously, you also had that happening for Amazon. You had a few recessions here and a few really crazy, like global financial crisis and so on. You can see it's really dropping here. But you had all these sorts of things happening, and Amazon just still made it. So the only really important thing is that if you look at a company like HIMS and HERS, is you look at the fundamentals of the business, you look at their balance sheet. Could they actually weather a storm? Could, it potentially, they are not growing as fast. They're losing a bit of money. Could they actually potentially weather the storm? And we had a look here at their most recent balance sheet. You can see that their current assets, so cash, inventory, short-term investments, anything you could sell, liquidate pretty quickly to have liquid means of payments like cash, basically. So they're all current assets, basically anything that can be converted into cash within a year. That's sort of the guideline there. We've got $239 million. And when you look down here at the current liabilities, so those are all liabilities. They are payable within 12 months. So what you usually should be doing is looking at current assets minus current liabilities to determine, are they liquid enough to pay the next 12 months of expenses. And basically here we can say that it's more than 5 times the amount of current liabilities compared to their current assets. So that means they have 5 times more assets than liabilities to pay those liabilities. So they could potentially pay them 5 times or 5 years as such. And then also, if you look at the long-term liabilities, this is where usually the debt would be. And obviously, in a rising interest rate environment, and for a loss-making company, you don't want them to have that much debt that if something goes wrong, that there's a risk of potential bankruptcy. But you can see that there is no such thing for HIMS and HERS. They have some other long-term liabilities here, which are only $500K, which they can pretty much pay out of their bank account like any day that they want. And then you have some other earn-out liabilities, which are, liabilities towards shareholders or directors probably who got that earn-out clause in their contracts, which are 1.5 million, which also seems pretty low compared to their cash balance at the moment. So they could just easily pay that. And operating lease liabilities are not even true liabilities that could become due all at once. It's more like the lease liabilities for your office buildings and so forth that you've already committed to. But usually, as you know, that will come on a monthly basis. They would pay that over time, so that gets just over time transferred here into the operating lease liabilities under current assets as they become due in the next 12 months. So you can see that 1.4 million becomes the next due in the next 12 months, and the rest longer term than that. So you can see definitely zero bankruptcy risk for HIMS and HERS, which, let's say we come into the recession, then you want to know that they can survive sort of, if a recession takes like 1 to 2 years max, then you would basically want to know if they can survive the next 2 years, which definitely I think is the case for HIMS and HERS. Then there's another factor, obviously, that we say that also because interest rates are going up, the risk premium goes up, which makes equity more expensive as well. And that's the reason why the stock price has been coming down to now only at $3.6. But at the moment, as I see this here, like they don't really need to raise additional capital as of now. Maybe later on, but for the near future, they should be fine with that, and they shouldn't need to raise additional capital, which is obviously one consideration as well, because either it's not gonna happen at all, it's gonna be very difficult to raise, or if they raise, they're gonna have to do it at a very bad price here at $3.60. That would obviously hurt us as investors very much, especially if you bought in at $8, $10, or $5 even. That's not something you want to see. But yeah, let me know what you think about it. Let me know in the comments below if you're any concerned at all, or if you're just basically a long-term investor, you're investing into HIMS stock, and you're basically thinking that longer term, you have a good opportunity here on your hands. And I do think that there is a place in the diversified portfolio here for HIMS and HERS stock for almost anybody that has a longer term horizon and wants to create some sort of wealth. It's not really in a wealth preservation phase, or not really close to retirement, obviously. So 5 to 10 year investment horizon minimum is required for something like a HIMS, definitely. But yeah, let me know in the comments, and see you next time.